FXN Mentoring. What's up, guys? Welcome back to Trading with Market Makers, and welcome to week 6. So, we're halfway through the 12-week program. I hope that the first 5 weeks that you've gone through so far have been good, have taught you a lot, and hopefully, week 6 will continue to teach you just a little bit more to keep adding on to what we've learned so far. So, we've talked about the market maker cycle, we've talked about entries, we've talked about patterns, we've talked about exits, we've talked about EMAs, we've talked about TDI. So, we've pretty much covered the core the core subjects of the actual strategy itself, right? So now we're going to get into the details of how are we putting everything together, right? How are we going to put everything together to make it a system that we can simply follow, okay? So what we're going to do is in this week's video, we're going to talk about 2 topics. One is going to be risk management. So what does that look like when you're trying to trade? What is the managing of money going to look like for you when you're taking trades? And then also how to put a plan in place regarding to the system, right? So how do you put a trading plan together that's going to benefit you and your individual style of trading? So as always, first things first, let's talk about things to keep in mind from the previous week. So I think one of the biggest things that I want you guys to keep in mind is that the EMAs are to be used for entries, confirmations, and take profits. That's it. The TDI is used for confirmations and divergence. When both are present, it creates a very strong trade setup. So whenever you have EMAs as confirmations and also along with TDI as confirmations and divergence, everything coming together makes it a really strong trade setup for you to take. You never take trade setups solely based on the TDI or EMAs. Okay? Remember that the trading that we do, we're trading patterns at the end of the day, okay, is what we're doing. The other tools, the market maker cycle, the actual timing, the EMAs, the TDI, the second leg patterns of railroad track, quarter wood, or star patterns, all those are confirmations and things that we're going to use to help us enter the trade. It cannot replace our ability to actually see the pattern and understand what market makers are doing or trying to do for that particular day. So in no circumstance are you solely want to take any trades just based off of the TDIs bouncing off the 50 or the TDIs making a W, or the TDI shows divergence, right? Or just because price action is bouncing off of an EMA doesn't mean that you're going to take a trade. Other factors that we've talked about throughout the 5 weeks have to be there in order for you to actually take a trade. Remember that you're here to make money, you're here not to give it away. Okay? Trading is already hard enough, so don't make it any harder on yourself by just giving away money. So let's go ahead and let's talk about risk management. Now, there's a couple things that are really important to understand when you talk about trading and really trading consistently and for a living for an extended period of time, for years to come. So one is you got to have a system in place. The second is you got to have a risk management system in place. So you got to know how to manage the risk. Because what happens when you don't have money to trade? If you don't have money to trade, you can't trade, right? So you can't do what you want to do. So risk management is literally the top, one of three things essentially that you need. You need to make sure that you have a good, solid risk management plan that you understand how to properly implement on every trade setup. All right. So let's talk about essentially money management 101. All right. So, literally, just like I just said, a system has to be in place for you to do this correctly. Right. So, the strategy. The plan needs to be able to control your risk and your money. That's what a risk management plan is. It controls the risk that you put out into the market and the money that you put out into the market, because those are the two things that you can actually control. You can't control whether Euro USD goes up or goes down, but you can control how much risk you put into the trade and how much money you put up for every single trade, and how you control that money. So, with that being said, you need to pre-plan your trades, right? You need to make sure that all of your trades are pre-planned, meaning that you just don't open up the charts and say, hey, look, Euro USD is going to be a buy today. Let me just buy. So before getting into any trades, you need to know, what is your risk going to be? How much of your account are you willing to risk? What lot size are you going to use? Where's going to be the best possible stop loss for you? Where's your take profit going to be? So all those things need to be in place before you actually take a trade. You need to expect losing streaks. They're going to happen whether you like it or not. Losing streaks are going to happen whether you like it or not. It's part of the game. So expect them. And the really cool thing about the risk management plan that I'm going to show you is I implement a way that you can expect the losing streaks to happen. And I show you a way to essentially not get rid, but expect and how to deal with the losing streaks that are going to happen. Because they're going to happen. Everybody has them. I don't care how perfect you are or how good of a trader you are, you're going to have losing streaks. Okay? So expect the losing streaks, and then you might as well learn how to manage them. Okay? There is a way to manage them. And I'm going to show you how to do that. All right? So, the money management plan, it has to have a way for you to deal with losing streaks. That's the first thing. Okay? It has to have a way for you to deal with losing streaks. It has to allow you to flatline the losses. You have to flatline the losses. The plan that I'm going to show you allows you to have a step equity growth curve. A step equity growth curve. So when you think about what a step equity growth curve is, if you were to think about like a pair of stairs, right? Stairs going up. There's an up movement, sideways, up movement, sideways, up movement, sideways. That's a step equity growth curve. Right? It's not going to be like parabolic move like what you see on Bitcoin going from, 10,000 to 20,000, right? It's going to be slow and steady, slow and steady, slow and steady, slow and steady, slow and steady. That's how you want it to be. And then finally, this money management plan allows you to move or reduce risk based on your wins and losses. Okay, so this plan allows you to move or reduce risk based on your wins or losses. That is huge. Okay, so let's break down this plan for you I'm going to switch over to the whiteboard and let's break down this plan. Here's the risk management plan that you should be using. The first thing is determining how much money do you have to trade. All right. So you have 1K in your account. What do you think should be your lot size if you have 1K in your account? So if you're trying to trade $1,000 account and your goal is to make 30 pips, that basically means that you're making $30 per trade. So every trade that you take is basically worth $30. Every loss that you take is worth $15. If you're risking $15 per trade because you're taking a standard lot size, what's the percentage of that of your account that you're risking per trade? Right, so the percentage that you're risking is 1.5%. Okay? So kind of basically like super low risk, right? Pretty low. Nothing too extravagant or crazy. So how can you make this work to where you can have a plan in place to where essentially you're trading and having to manage your risk along the way? Here's how I would do it. If I have $1,000 account and the lot size that I'm trading is 0.10, here's what I'm thinking in my head. The actual lot size of 0.10 is my max lot size. So 0.10 is my max. That's the max lot size that I can use on one trade. But what if you wanted to trade 3 pairs? What if there's setups? What if there's really good setups on like 3 pairs? What do? Do you trade 0.10, 0.10, 0.10 on each pair? Right? You definitely don't do that, right? Because then you're risking 1.5, 1.5, 1.5, right? Now you're up to like 4 something percent of your account, right? So you're not doing that. So here's what I would do. I would start out with trading like this. So my first trade that I would take is actually at a point 0.06 is my first trade. And this is what the premise of you taking one trade at a time. Okay? If you're taking multiple trades, then you split this in half. But let's just say we're taking one trade at a time. So if you take a 0.06 trade, the first trade that you take, and let's say you win that one, right? The next trade that I take, I'm doing a 0.7. If I win that trade, cool. I go to a 0.8 the next trade. If I win that, the next trade I take is a 0.9. If I win that, then the next trade is a point W or a point 0.10. So I've taken 1, 2, 3, 4, 5 trades. Let's say that I've won all the trades. Okay. What usually happens after you win 5 trades? Think about what your emotional state is after you win 5 straight trades. What are you thinking about? How high is your confidence? So, what typically happens to the retail trader when they get 5 wins in a row? They're like, man, this is way too easy, right? Why am I trading a 0.10? Why don't I trade a standard lot instead? Right? And so what's probably going to happen when he trades this one lot size? A loss is coming, right? So all the profits that you did great on all your 5 trades here are gone, and you jacked it up on one trade because you over leveraged your account, right? So to account for this is what I do. So if I get 5 wins in a row, okay, my next trade after this, I'm actually going back to 0.06. Because if I take a loss on the next trade, I'd rather be at a 0.06 than at my max lot size. So that's what I'm doing on my next trade. If I win this one, awesome. I do it all over again. 07, win. 08, win. Keep doing the same thing over and over and over and over again. Right? So I keep doing this. As long as I'm winning, I keep doing. I go one up until I get to the max. Once I get to my max, I go back and start over again. Because I'm expecting a loss. At some point, it's going to happen. I'd rather it be at a 06, 07, 08, 09, right? I don't want it to be at a 0.10. Okay? So now let's say I had this, I did it, I won all 5, I go back to 0.06 right here, right? And let's say that on this 0.06, let's just say I actually lose that one. My next trade that I take is still at a 0.06. If I win this one, cool. I go back and I go up to a 0.07. If I lose this one, I'm going back my next trade to a 0.06. So let's say I win this one, and then I go up to a 0.07. I win this one, I go back to a 0.08, and let's say this one I lose. Cool. I go back, my next trade is a 0.06 again. So every time that I lose a trade, I go back to my smallest lot size. So this allows me to automatically account for my losses. I'm already expecting it, right? So if I take a loss and I go back to 0.06, and then the next trade I go 0.07, I take a loss. I'm sorry, let me rephrase that. If I take a loss at 0.06, my next trade is again a 0.06. If I take another loss, my next trade is a 0.06. If I take another loss, my point is a 0.06. So if I'm losing, I'm not going anywhere up in my lot size. I'm staying the same. Right? But now, what is the problem that I encounter here? What am I in right now? So I'm in the middle of a losing streak. What do I do? I stop trading. If you get to 4 losses in a row, you stop trading. And I mean stop trading for like that day or the week or whatever, depending on how these losses come. If you've taken, if you're taking a trade, let's say one trade a day, and you've lost 4 trades in a row, stop trading for the week, or cut the week short and call it a day. Okay. So if you've taken 4 trades in a day and you've lost 4 in a day, just stop trading for that day. If you've taken, 4 losses in a week in a row like this, stop trading for that week. There's no point in trying to keep trading, because after 4 losses, your mindset is all about trying to get the money back, and it's no longer about trying to find the right setup. Your mindset is about revenge trading to get back your money that you lost. You start losing, and it seems for the life of you can't get not even one damn pip. Not even if they're giving them away, you can't catch them. And so you end up making just really stupid mistakes for no reason. So just stop trading. Cut the losses already. It's like you're literally like bleeding out money. So cut it. Just remember that you're not here for a trading of a week or a month or whatever. You're trying to do this for years to come. You can't sustain the kind of losing that that you're doing. So just cut it. So what do you do after that week or the day is over? How do you get back? You got to have a plan to how do you get back on the winning side of a trade, right? How do you find a winning trade? So what you do is you go ahead and you have a signature trade. What the hell is a signature trade? You may ask. A signature trade is a trade setup that will get you a win. Think of different trade setups as different, playing cards. You want to play your ace. So if you're really good at type 1 setups, or if you're really good at continuation trades, or if you're really good at type 3 setups, whatever that setup is, that's the one that you're going to use. So essentially, you're not going to take a trade until you get that specific trade to show up on the charts. So whatever that trade setup is, whatever it's, continuation trade, reversal, type 1, 2, 3, 4, whatever. Whatever your best trade setup is that you know well, that has all your confirmations, all that stuff. That's the next trade that you're taking, and you're not taking any other trades besides that one. And so once you do it, obviously then the cycle starts over again, right? You still do a point W, and then you could start going again, essentially. Now, what if you run into a situation to where your balance, let's say your balance of 1K that you initially started with drops below 1K. So if your balance is ever below the initial starting point that you had, you're doing nothing else but trading 0.06s, 0.06s until you get back up to your original balance. If your balance gets to be 20% or less. So in this case of $1,000, if it's like, let's say $800, so say your balance drops to $800, you cannot trade a 0.06 as your minimum stop loss. You have to make the adjustments, because at $800 your max lot size should be a point. So then just do the math. If your max lot size is a 0.08 at that point, right, just go backwards. 0.07, 06, 05, 04. So you're trading at a 0.04. And you're still at a 0.04 until you get back up to 1K. When you get up to 1K, you can go back to your 0.06. So if your account balance ever drops below 20%, so in this case from 1K to 800, you need to adjust your lot size correctly. So you can literally account for the fact that you lost to 20% of your account. Because if you don't adjust your lot size at that point, you're basically now trading an $800 account close to your maximum lot size. And so if you take any losses, this is going to drain a lot faster. This is why if you have 4 losses in a row or more, just stop trading. Go back to the minimum lot size, and then go ahead and trade the signature trade, whatever that may be. You're not trading anything else but that signature trade first. If you want to trade, like, let's say if you want to trade more than this, you need more of that. So if you want to trade more than this as your max, you need more of money, more money, right? So let's say that you started with 1K, right? You trade your 0.01 or your 0.10 lot, and let's say you do this plan and you grow it to 2K. Once you get to 2K, now you can up your max to this as your max. So every $1,000 you go up, you raise it basically. So 3K would be 0.30. And it's the same thing, right? If you have a 3K in your account and your max is 3.0, then you're just going back down 5. So you're doing what, point 26, 27, 28, 29, 30. For the compound effect, if you're trying to really grow an account yourself, like from scratch, right, you have to allow the compound effect to take place. The compound effect on a trading account really doesn't even get started until you get to 10K. That's when it really starts. Because at that point now you're trading a standard lot size. And so at that point now it's $300 per trade. So if you really think about, what in general, how many people if you take a poll of 100 people, you're like, hey, every month, about how much money would you need a month to kind of survive, and just live a normal good life? What would you think that number is? To live it, I'm not talking about like living like an extravagant lifestyle. I'm just talking about living a good normal life, having your bills paid, having all of your bills paid, being able to support you, your family, or whatever. Everybody's number is different, right? We get that. But like in general, if you ask somebody, hey, if you poll 100 or 1,000 people or whatever, I think the average is going to range somewhere around 5 to 6K or something like that. Depending, of course, on where you live. If you live in New York, you fucking need some crazy amount of money. Same thing if you live in California. California and New York are like the two anomalies because they're so expensive to live. But let's just say if most people can get by with 5K a month, what does that translate to into actual trades, right? So if you're making, let's say, 300 per trade, that's about 16 trades or so a month. So 16 trades per month, what does that come out to a week? It's like 4 trades a week. So 4 trades a week, $300 a trade, that's $1,200 a week. Times 4, it comes out to like 4,800 or so. So if you just get to 10K, this is where your account can really compound, or starts to compound. This is why it's so important to still have a job. Because once you get it to 10K, now you're good. Now you can really start to see the effect on your trade or on your trading account. Because if you want to live off the profits of your trading, you need to build your account first. You can't quit your job if you just have 10K in your trading account. What I'm saying is, once you get to 10K, you'll see your account grow a hell of a lot faster. Nowadays, though, with the added the addition of like all these prop firms that'll give you the money to trade, that's no longer a real problem. Now it's just talking about, do you know how to trade? The money part is no longer an issue. You not having 10K to trade, you not having $1,000 to trade, now that's no longer a problem anymore, because you can just trade with a prop firm and they'll give you 100K. You just need to know how to trade. So now the opportunity of you actually making 5, 6, 7K are way more realistic. Because if you know how to trade and you have $100,000 account, I mean, just do the math. What's your lot size? What's your lot size on a 100K account? So on a 100K account, what is, and you're trading 10 lots per trade, what's every trade worth? If a standard lot is worth $300, what's a 10 standard lots worth? So every trade is now a 3K trade. I mean, I'm not no mathematician or something, but if you take 16 trades at 3K per trade, that's a pretty big chunk of change. When you have an account like that, realistically, there's no reason for you to even trade a 10 lot sizes. You know what I mean? There's no reason to even stress about trading the max lot size. You could trade five lots. If you average 16, I mean, you're still making like 24K a month. Like, what are we talking about? So everything opens up, I'm telling you, once you have the money in the account. The possibilities are endless. All right, guys. So I hope that going through that risk management plan, you understand how I came up with it and why I designed it the way it is. Okay. It's allowing you to take your risk as small as possible, and it's allowing you to grow your account based on how you're doing on your wins or losses. So now that you know what the risk management plan is or how you're going to use it, let's talk about a trading plan. You need to have a trading plan, right? So the trading plan, when we're talking about creating a trading plan, the first thing that you need to keep in mind is the trading plan itself. Why is it important to have one? It's important to have one because it keeps the trader on track and consistent with the decisions that he or she is making. So remember that as a trader, the biggest problems that you're going to have are going to be mental, trading psychology. Okay? So if you create a plan and you backtest that plan, and you know that if you just follow the plan consistently over an extended period of time, let's say over 12 months, will give you an overall winning percentage, let's say of 80%. Okay? So if you know that if you just follow your trading plan that you've backtested to the T, you'll get 80% winning percentage, why would you not follow it? Think about it. Why would you not follow it? If you follow it, it'll keep you on track and it'll just keep you consistent with everything that you do. And that's the whole point of the plan. Now, another key point about creating a trading plan is that the plan itself has to be customizable to the trader itself. This cannot be a cookie cutter type of plan that everybody could follow because not everybody thinks the same way. So the plan itself has to be customizable to the individual trader. Okay? So please keep that in mind. This is not a cookie cutter type of trading plan. This is why I can give you a trading plan, but based on how you are as a trader, you need to customize that plan to fit you. Now, the trading plan itself, it should be simple to understand and to follow. Okay? The trading plan itself that you create should be very simple and easy to follow. Nothing complicated. No complications. Okay? No complications. The trading plan that you created must be rules-based. So meaning the trading plan itself has to be based off of rules. Because when you have a trading plan created based off of rules, it keeps you basically on track and consistent. Because you're just saying yes, no, yes, no, yes, no. It's a very black and white. It's either following the rules or not following the rules. You know? So let's jump back into the whiteboard and let me show you how you can create a simple plan for yourself to use. Okay, I'm going to give you an example of me creating a plan for myself for trading a specific type. All right, and then you could basically get some ideas as to how you can create that. Let's talk about it on the whiteboard. All right, so now that we're on the whiteboard, let's talk about creating a trading plan. So here's a couple things that I want you guys to keep in mind when you're creating a trading plan. I want you guys to think about the last 5 weeks. And I want you guys to think about over the last 5 weeks, what has been some of the things that you found to be very successful to you? So meaning, think about the patterns themselves, type 1s, 2s, 3s, 4s. Out of all those examples that you guys did for homework and you guys did over test, what patterns come to mind that have been the easiest for you to follow, to see, to trade? Okay. What are those specific patterns? And the reason I want you guys to focus in on that is because when you can focus in on a specific pattern that you're really good at, you can start to see them on the chart a whole lot better, and you'll start to trade with confidence. Okay? Now, if you see yourself being able to trade all three patterns or all four patterns, that's fantastic. That's great. Awesome. Okay? But what I'm going to show you is how I would create a trading plan if I wanted to trade my favorite type of setup. So let's say that my favorite type of setup is going to be a type 3, and that really is my favorite setup. So a type 3 setup trading plan. So when you think about that type of a trading plan, what's the first thing that comes to mind when I'm trying to create a trading plan that I want to be rules based, right? So when I think about being rules based, I think about simply putting in certain factors that have to be there in order for me to take a trade setup. Okay, so if I'm looking at a type 3 setup, the first thing for me is directional bias, right? So I must have a directional bias set up first. So I got to have a directional bias. That's the first step. Okay. Once I have a directional bias, I know whether I'm buying or selling. So this could be like, think of it like a checklist, right? It could be as simple as yes, no. So you could have it set up. You could create like a spreadsheet or whatever of this, and just have one directional bias, yes or no. Basically, you're asking yourself, do you have a directional bias, yes or no? If you do, yes, cool. What's the next thing? For me, if I'm looking at trading a type 3, is did price action come from the top or bottom and get stuck in the middle of the range? Yes, no, right? That'd be the second question. So I'm automatically asking myself, did price action come from the top or bottom, right? Because I don't want to trade a type 3 that comes out of the Asian range through the middle, right? We talked about this during the patterns themselves, that on type 3 setups, you want them to come from the top or the bottom and then get stuck in the middle, right? So that's my second question to myself. Did price action come from the top or bottom and get stuck in the middle? Yes or no? If it did, cool. Let's go to the third one. The third one would be, is price action bouncing off the 50 EMA? Yes, no. Is price action bouncing off the 50 EMA? Yes or no? Four, did price action give me a pattern to trade, or to enter actually, once it was rejected from the middle of the range. Yes, no. All right. And I'm doing these in the form of a question, but you can do it however you want to. So for example, instead of saying did price action give me a pattern to enter the trade once it got rejected from the middle of the range, you could just simply say, do I have a pattern to trade at the middle of the range? Yes or no, right? And you're basically asking yourself, did the type 3 give me a railroad track star pattern quarter wood in the middle of the range that I could trade to enter? Right? So another thing is if I'm trading this, let's say my pair is pound USD, right? So on pound USD, my stop loss is going to be about at max 20 pips, maximum. So the next thing I'd ask myself is the risk to reward ratio, is the RRR risk to reward ratio 2 to 1? Yes, no. So I'm just basically asking myself, is my risk to reward ratio going to be 2 to 1, or is it 2 to 1? Can I get a 2 to 1? Next thing I would ask is the TDI bouncing off the 50 line? Yes or no? What am I looking for? I'm looking for a confirmation, right? The 50, is the price action bouncing off the 50 EMA, yes or no? And is the TDI bouncing off the 50 line? Those are confirmations, right? Another thing is the pattern, or not the pattern, the setup. Is the setup happening at the right time or at the correct time? So meaning, is it in the box? That's what I should say actually. Is the setup happening inside the London or New York box? Yes or no? Right? That's going to be the timing aspect of it. You follow me so far? Everybody follow me so far? So right here you have a list of 7 things that you would ask yourself, or that I would ask myself, if I want to trade a type 3 setup, if I'm creating a trading plan basically for a type 3 setup. Number 1, and these are just simple yes or no, yes or no, yes or no. Because they're yes or no questions, it basically creates a very black and white trading environment. Yes, no, yes, no, yes, no. Is it directional bias? Do I know my directional bias? Meaning, can I identify the closest peak formation high or low? Right, that way I know in what direction I'm expecting a trade to set up to go on. So yes, I know my directional bias because I'm coming off of peak formation high. Okay, great. So I'm looking for sells. Then did price action come from the top or bottom and get stuck in the middle of the range? Right? So it's asking me, I'm asking myself, did price action do this? Yes or no? Yes, it did. It came from the bottom and now it's getting stuck in the middle of the range. Cool. So is price action bouncing off the 50? Yes or no? Yes, it's bouncing off the 50. Okay, great. Did price action give you a pattern? Yeah, it gave me a star pattern. Great. Yes. Okay, now that it gave me a star pattern, start putting in your risk to reward ratios. Can you get a 2-to-1 out of it? Yes? Yes, I can. How about, is the TDI bouncing off the 50? Yes, it is. Is the setup happening inside of the London box? Yes, it is. So now you basically just confirmed 7 things about the setup. If you said yes to all 7, guess what? Enter the trade. You can add, if you want to, an 8 of, did you get a pullback? If the risk, did you get a pullback? Yes. No. Also, did you get a pullback? If the entry, or if the risk was too big. Yes, no. All right, so now you're asking about a pullback. Did you get a pullback, yes or no? And did you get a pullback if the risk was too big? Meaning, let's say if you had a star pattern for that type 3, you know, sometimes that second part of the star pattern could be a really big ass candle, right? So it basically make the trade untradeable because of that big candle. Well, did you get a pullback after that candle? And is a pullback that you can get out of that candle, is it big enough for you to essentially get a decent risk to reward ratio at that time? Like what we talked about, you know, pulling back half the candle or whatnots. Right, so this right here is a simple yes or no, very black and white trading plan for a type 3 setup. Okay. Now, if you want to trade, let's say all of them, let's say type 1s, 2s, 3s, and 4s, right? So now, if you want to talk about trading the entire thing, now you're just talking about trading plan for everything. Trading plan for all setups, right? The number one thing you got to have is still directional bias, right? Directional bias. You can even put it to where you're answering the question of not yes or no, but you can put directional bias. You can put sell or buy, right? 2, if we're like, say, let's selling, you're waiting for a setup to happen, right? So think about the things that you need. Because we're trading all the different types, we can't specifically have, you know, did price action come from the top or bottom? We can't have that as a question. So now you got to start thinking to yourself, okay, what are the things that we're looking for now, right? We're looking for 5, because we're looking for type 1s, 2s, 3s, 4s, right? We're looking for M or W, right? So M, did you get a M or W pattern, right? That would be another question would be timing. Is the timing correct? So we have the pattern itself, the timing, 5 candles between first and second leg, right? What's 5? Or the EMA's pinning to price action. So now we're basically just going through the different forms of confirmations and rules that we need for the entry, right? Is all we're looking for. So we're looking of what pattern are we getting? Are we getting a type 1, 2, or 3 pattern once we identify the directional bias? Is the timing correct? So is it happening at the right time? So either London or New York box. If we're talking about an M or W because it's a type 1 or 2, did the second leg, are we having 5 candles between the first and second leg? And then we're asking ourselves, are the EMAs pinning the price action, right? So is that type 1 setup that's happening, is it pinning to an EMA, right? So we've covered the pattern, the timing, the 5 candles, the EMAs, and now we're looking at TDI, right? Are we getting a confirmation on the TDI? And are we getting divergence? And then are we getting a second leg pattern? Are we getting a second leg pattern? So are we getting a second leg railroad track star pattern quarter wood, right? And the same thing as lastly as pullback. Is there a pullback? Nine, risk to reward ratio. What is it? Is the risk to reward ratio there? So now you pretty much have a quick list of 9 things. You can word it however you want to. It doesn't matter how you word it. But as long as you understand what this is. Directional bias first. Once you know the directional bias, now you're waiting for the pattern. Based on what price action is doing, what's the pattern? Right? Do you notice that price action is basically stuck at the top of the Asian range? So it's creating a type 2. Okay, cool. So if it's creating a type 2, then we're looking for what? A second leg that produces after at least 5 candles or more after the first leg. Right? That'll be that confirmation there. Do we happen to have any EMAs that are right above that price action that's keeping or that's going to keep price action there to be a type 2? Look at the TDI. Are we getting the same M pattern on the TDI when it's close to the 60 line on the TDI? Are we getting divergence on the TDI at the same time? Did we get a second leg pattern finally on the type 2 pattern? Cool. What's our risk to reward ratio if we take a trade? Can we take a trade without a pullback? And then execute the trade once you know what the risk to reward ratio is. So that's it. That's a really simple way to create a trading plan. And so what you can do is If you want to create a simple trading plan, like let's say for a type 3 setup, or create a type 2 setup plan, type 1, type 4, whatever you want to do, go ahead and do it. And you'll just basically have, let's say, 4 trading plans that are like this, very short, quick, and easy, right? That you can print out on paper and have it in front of you. Print out one piece of paper and split it into 4 sections and literally have for, type 1, 2, 3, and 4. And if you want to, you can like laminate that paper, get a marker, and just mark every question as you're seeing this happening. And as long as all the conditions are met, you can take the trade. So here's the thing about this is that this is the way that I would do it, right? Because I would want to have, if I'm taking, let's say, a type 3 setup, I would want to have an actual price action pinning to the 50, right? I would want to have a railroad track or star pattern as the pattern that I'm trading, you know? But that's just me. I would want to have the TDI bounce off the 50, right? So this for me here would be my requirements for me to take a trade. Because I know that if all these things are aligned and they meet up together, I know that that trade is going to be a pretty good damn trade. And the likelihood of me winning that trade is extremely high. And I myself, I'm willing to wait for this to appear. Right? Now here's what some of you might have a problem with, is that some of you might not have the patience that I have. Right? Because if I'm willing to wait for this specific pattern to show up, or for these set of rules to be met, I could be waiting 2 or 3 days, hell, a week, I don't know, right? But I'm willing to wait because I know once I do find that trade and once I take it, it's going to make up for the days that I didn't trade. But again, that's just my preference. And so this is where you have to customize it to your own preference of how many confirmations do you want to have. You may only want to have, you may not care if price is bouncing off of a 50 EMA on a type 3 setup. You may not need that requirement for the trade to be good. You see what I'm saying? So it's important. This is when you start to really think about, out of all of the setups that you've gone through the 5 weeks so far, which ones have really resonated with you as far as you finding them very easy to identify. And so once if you find that type 3 setups are really easy for you to identify, okay, great. Now your job is to find out what pairs produce the most type 3 setups, or what pairs produce the most type 1 setups if that's the setup that you want to trade. There are certain pairs that produce more type 1s than other pairs. We did a study, this is one example. We did a study on type 1s. We found that if we went back 3 years on pound NZD. On pound NZD, we found within a 3-year period that it would produce about 40 to 45 type 1s. Throughout the same time frame on pound USD produced 4 times that on type 1 setups. So if you're a type 1 setup type of person and you like that setup, cool. Pound and ZD may not be the pair for you to trade for that specific setup. You may want to look at Pound USD instead. So this is where the backtesting part comes into play, right? Because when you're backtesting, you're literally looking at and finding what setups these particular pairs do the most. And so it's very important as well that throughout this 5 weeks, you've had your hand in a lot of different pairs. Think about the pairs that you've gone through, especially when we went through weeks 1 and 2 when we talked about the market maker cycle. Think about those different pairs that you went through and you've gone through so far. What pairs have been easy for you to follow the market maker cycle? That's going to be a lot to think about, because if you found a pair that produces or that you're able to follow really good on market maker cycles, that's going to be a really good pair for you to trade, because you can follow it and you can follow the market maker cycle on that specific pair very well. So then you got to ask yourself, okay, well, if that particular pair, if I can follow that market maker cycle on that pair really well, okay, what are the patterns that this specific pair is producing the most of? And then go ahead and make a trading plan for that specific pair based on the patterns that pair produces. This is a portion, the trading plan, the backtesting, this is the portion that takes the longest amount of time. This is a part that nobody wants to do. Right? Everybody wants to trade, but they don't want to do the backtesting or the planning. You just want to trade and win. And you expect to win, right? But you produce no planning to do it. That makes no sense. All right? So think about this. When you're putting plans together for these setups, think about what type of trader you are. What pairs have you found super easy to follow? What pairs have you found extremely difficult to follow? There's no point in you following a pair or trying to figure out a pair that you find difficult to follow. It just doesn't make any sense for you to do that. It's a big waste of your time. So just remember, make your trading plan simple. Simple for you to understand. Don't overly complicate it. You can make it as simple as yes or no, or you can make it as rules, right? Rules like a trading plan of like, I need a directional bias, I need a pattern, I need the timing, I need the 5 candles, I need the EMAs, whatever. Right? So those are all rules. You know, the 6 rules here need to be in place for me to take a trade, right? And so if you start looking at your specific, if you start looking at your specific charts, your specific pairs, your setups, look at the setups themselves. Look at the actual setups. I mean, hell, you just made over the past 5 weeks, you've turned in, I don't know, like freaking hundreds of examples. Look at those examples. You don't even need to go look at the charts. You've turned them in through email, right? So look at all those examples that you sent in and look, especially the ones that had the entry, especially the most recent ones where the EMAs and the TDI and stuff like that. Look at those examples. Use those. You already have all the examples. Just look at your previous 5 emails that you've sent to me over the past 5 weeks of the samples that you've turned in. I've given you guys feedback on all those. So you know which ones are right, which ones are wrong. You can literally look at those examples of type 1s, 2s, and 3s, and 4s and just look at the examples. They'll tell you what's there, what's good, and what's not. What are the common things that they all have in common? What are the different confirmations that all type 3s have in common that you would like to have? What are all the confirmations that you would like type 2s or type 1s to have? The more confirmations that you have, the better trade setup is going to be. However, that trade setup is not going to happen every day. So if you're a very impatient person and you need to have something to trade like every day, then you might not want to have 8 things to confirm a trade setup, right? At the same time, though, the less confirmations that you have, the more risk that you're going to take. And that's why, for me, I'd rather have all of my confirmations there before I take a trade, because I hate losing. I don't want to lose. Even though it happens, I don't want to lose. So I'd rather just wait. But if you're not able to wait, we understand everybody's different. But just make sure that you're okay with the fact that you might be losing a little bit more than you might like to. But I think as we get into the back testing and as you start back testing yourself, you're going to start to notice the pairs that you like, the pairs that you don't like, the setups that you're really good at versus the pairs that you suck at, or the setups that you're not really good at. And just being self-aware of that and being able to identify that is going to play a huge key for you. It's going to play a huge key for you. So let's talk about homework. The homework this week is going to be very simple. You're going to build your trading plan, is what you're going to do. That's it. You're going to start to build your trading plan based on everything that we have done so far in the past 5 weeks. Start building your trading plan. Either a trading plan for a specific setup, or a trading plan for the entire strategy or the entire system itself. So if you're open to trade type 1s, 2s, and 3s, 4s, whatever, go ahead and start to create the trading plan for that. But that's your homework, is to create the trading plan. I want you guys to really focus in on this and make sure that this gets done this week for homework. All right, I'm not going to give you guys a test this week, because I really want you guys to focus in on creating this trading plan. If you like to get some feedback on the trading plan, create it, send it to me, and I'll give you feedback on it. But again, there's no wrong way, because it's your trading plan, right? And so once we create the trading plan, we're going to go ahead and then start to backtest that trading plan, right? And so once we start to backtest the trading plan, then we can really, really start to focus in on customizing it, what needs to be taken off versus what needs to be maybe added to it. Okay? But the first thing is we need to create one. And then we can start to backtest, and then we can start to mess with it. All right? So that's what I want you to do this week, is to create a trading plan. Keep it literally as simple as I showed you. All right? Guys, thank you so much. I hope you enjoyed this week, and I look forward to giving you some feedback on the trading plans. Thank you so much, and we'll see you guys in the Sunday session.